Investors, welcome to Trade with Raymond. Today I'm discussing two ways of taking profit. First of all, the dynamic profit taking method. With the dynamic profit taking method, we do not have a fixed area or fixed price point where we are taking profit. We tend to follow the trend because ichimoku is a trend following tool. So we follow the trend to a reasonable conclusion where the system literally kicks a trader out with a trailing stop profit. So for example, we have a clear bullish indication here that the market is bullish. So we come to our 4-hour time frame. This trade set up somewhere here on this candle. Wonderful setup. So you have a setup, you have a market, just a little pullback here, then boom, trend continuation. So where's the stop going to be? Behind the blue line. All right. So you have this trade, you have a stop size of let's check that. That's about 88 pips, 78 pips, let's say 80 pips. It's not a big deal, it's good. And what do you do here? You wait till you see 60 pips. You wait till you see 60 pips. All right. So once you have 60 pips, okay, let's measure 60 pips. 60 pips is just somewhere here. All right. Once you see 60 pips, you pull your stop loss into break even, lock in some 2 pips or 3 pips or your spread, and the New York market has closed, so the spread has widened a bit. That's why you see the spread at 9. It's because the New York market has closed. So then you wait for the parabolic SAR. Okay, when you go to your indicator zone, you find parabolic SAR is default. Do not change anything. It's default. Okay, let me just click it for you to see the setting. This is the setting. Okay, it's default. Do not change it. It comes in green. I just use a different color. So what I do is that I wait for the SAR, which is oftentimes slow, to catch up. It's better, it's slow. Then I pull it to the last but one pip. So what happens? The last but one dot. So what happens is that if I have a new dot, I'm going to push it. So the push started from somewhere here. There was always a new dot, so you follow. You are always one dot late, one dot late, one dot late. So this is dynamic. So as it continues to go, you follow it that way. In this method, you have locked in some almost 100 pip. Yeah, you've locked in some 100 pips and allowing the trade to do what he's already been doing. The deal here is that you're looking at taking profit from a trend following approach. I remember some time trading, I literally followed just one pair for 25 days and the dots just kept climbing, and you keep following and making profit. So this is the dynamic approach. And what happens here is that when the market reverses to hit your trailing stop, you still have your 100 pips. And don't be worried about what is here because you have chosen to go trend following. So you allow enough time for the trade to pull back and resume its trend. This method has its weak side. That is something you have a lot of pips left here and it comes to kick you out. But also sometimes it may just return and may never go back. So you have locked in enough profit. So this is one of the ways of taking profit. And this is what I call the dynamic profit taking method. Then we have the hard profit taking method. Here we set an entry and an exit point. This is how it starts. So now, first of all, you have a bullish behavior. You have to target a flat Kumo top or a flat Kumo base, depending on how the Kumo is arranged. So over here, this area, we have a flat base somewhere here. So we put in a line. Then we start business on the 4-hour time frame. So back to where our entry started from. The entry we got initially was here, and then the stop was down here. What happens in this method is that you take a position. As soon as you see 60 pips, you literally move and lock in some profit. Same method. However, you put in a hard take profit price point in your system. So The flat base on the weekly can be seen on the 4-hour by just squeezing the chart and pulling it down a bit. This is the area. So while our entry was here, and then let's pick it from the protective stop, the break-even stop, and pull all the way. We're talking about some 330 pips there, about that's what we expect this trade upon full maturity to give us 330 pips. But this approach, once you move your trailing stop, you can literally leave the chart and go do some business, and I mean travel abroad and do anything, because sometimes it may take 2 weeks to get there, sometimes a week to get there. It depends. We do not know what the market is going to do. The other disadvantage is that it can just turn around and come here trailing stop, and you just have 2 or 3 pips in here. So between the dynamic approach and the hard take profit approach, they have their own. You can clearly see the advantage and disadvantages there. So it's an awesome way of trading. I mean, you can apply this method. Let's look at another pair. There's some occasions where, okay, let me look at this pair, for example. All right, I'm going to go to the weekly time frame. So to find a flat base, so the flat base that we don't have it, we have a flat Kumo top. So it means that our take profit is going to be here. So coming to the 4-hour time frame, if you pick your entry from this area, okay, it means that your take profit is going to be all the way at the top. So I mean, so it's all the way almost about some 560 pips. That is if you move into break even plus 3 or 4. And then as I said, New York has closed, the spread has widened, but when London comes in, the spread is supposed to just come back to where it used to be. So you have this opportunity. I mean, this huge 400 or something pips where you can make some profit, and that's how it is done. So we picked it from the flat top, and then that's awesome. That's a wonderful way of trading ichimoku and for you to become profitable. So guys, let me see what you think. You can write to me, send me a text message, email, put a chat, you can ask the question in the chat box, and as well as keep following us for more ichimoku lessons on this master series. Thank you very much, and keep trading.